The following discussion and materials are to be used for informational and training purposes only. They are not intended to supplant the requirements of the Assessor's Reference Library, the Colorado Constitution and statutes, and relevant court case law. You should consult and rely upon appropriate legal authority. Welcome to the Colorado Division of Property Taxation's video library. We hope you gain useful information and enjoy our presentation of this course.
Okay, so again, my name is Michael Kruger with the division. So this is basically how the course is set up. We'll talk a little bit about depreciation in general, types of depreciation, physical, functional, economic, what those are, how they're estimated, things like that. And then again, we'll get into more estimation methods, which is how do you actually do personal property depreciation. We will spend a little bit of time talking about the Iowa curves, even though in the counties, you are not the ones who develop the depreciation table. Obviously, we do that at the state. It's good to know what it's doing, how it works, why we use it, because it comes up in appeals with some regularity. The Iowa curves are actually quite good and quite reliable, but they're also difficult to understand. They're statistical tests about mortality studies, and they're hard to explain, but we'll go into that a little bit. We'll also spend some time talking about inutility. For those of you who have taken the advanced personal property class, that part will be a little bit review. The materials are basically the same as that, but we'll talk about inutility, how you measure it, what types of property you can use that for. And I skipped over age life on purpose because then we will talk about age life. Age life is probably the most common depreciation estimation method that's used by just your typical personal property fee appraisers. That's going to be the main methodology that you'll see as age life. So we'll talk about it, and there's a reason why the numbers that are determined using an age life methodology are different than what are determined using the Iowa curves. And it's because they work differently. And so inherently, if an appraiser comes in and brings an appraisal and an appeal, and they're using age life, right off the bat, their numbers are not going to be the same as your numbers because it's a different way to depreciate property. We're going to talk about types of depreciation. So the basic definition of depreciation is a loss in value of an object relative to its replacement cost, reproduction cost, or original cost, whatever the cause of the loss in value. Okay, so basically a loss in value to the property is some form of depreciation. And we break that out into three different kinds of depreciation or obsolescence, and that's physical depreciation or deterioration, functional obsolescence, and then external or economic obsolescence. One of the things we're going to talk about is what each of those is and how to measure them and adjust for them. But one thing to keep in mind is even though we can and do make distinctions between those things, and you should be able to separate them, especially when you're claiming some sort of additional obsolescence beyond what's typical. Remember, depreciation is really depreciation. And so at the end of the day, when you actually apply depreciation to an asset, you're applying generally an overall factor that's accounting for all forms of depreciation. And so even though we make distinctions and we break them out, in a little bit, we'll talk about one of the ways to measure obsolescence, both functional and economic, is through direct sales comparison. But when you look at the sales of comparable obsolete property, that sales price reflects all obsolescence and all depreciation, not just a particular type of it. So it's going to be careful. We'll talk about this later, but you'll be careful not to double deduct, because you can make an adjustment for one kind of depreciation, and then if you add on another one, you can end up overstating the depreciation. So we'll talk about those three different kinds, and then we'll also talk briefly about curable versus incurable and how that relates to depreciation, because those distinctions are very important. And then we'll also talk about some age issues, the difference between an effective age, actual age, economic life, and normal useful life. And those are important because the life of the property is directly related to how that property depreciates. And you can think about that, that's kind of makes sense. If you have a property that has a 10-year economic life, what does that tell you? It tells you that over that 10-year period, in terms of its economic life, it's going to start losing value. And by the end of that economic life, the value is going to be fairly low. We have, because of a value in use, we stop it at 15%, but that's the idea, right? a property with a longer economic life is going to depreciate slower. A property with a shorter economic life is going to depreciate more quickly. So those concepts, even though they're life concepts, are directly related to how property depreciates. So the first thing we need to talk about is curable versus incurable. And what this means is when we're talking about depreciation or some sort of obsolescence, we consider it to be curable if the cost to remedy that, to repair it, replace it, correct whatever the defect is, or the obsolescence, it's curable if it's economically feasible, which basically means if the cost to remedy the problem is equal to or less than the income or the benefit generated if you were to cure that obsolescence. So a good example of this is, say, like deferred maintenance. So if we're talking about like physical depreciation and you have property and let's say it's a piece of machinery and it just needs some maintenance. If it makes sense economically to do that maintenance, that's considered curable obsolescence. And you see that especially with heavy machinery. Heavy machinery is very expensive. Capital intensive industries have very expensive equipment where a lot of the physical depreciation or even some of the functional obsolescence is going to be curable because there's so much capital investment in that machinery that you can make those repairs, you can make those changes, and they're clearly curable because you're going to extend the life of that property and it makes sense economically to do it. Incurable depreciation is when that cost to repair, replace, or correct the depreciation or obsolescence is not economically feasible, where it doesn't make sense to do it. It would cost more to remedy the depreciation than what the property would be worth and what kind of benefit you're going to receive from it. And in a second, we'll talk about how some forms of depreciation are generally always going to be incurable, and that's economic. And then some are generally curable, and we'll talk about that in a second. So the first kind of depreciation we're going to talk about is physical depreciation or deterioration. So this is going to be your general depreciation due to normal wear and tear from using the property or from the elements. So if you use property and it's exposed to the elements and that personal property is weathered and things like that, that normal wear and tear is your physical depreciation. And typically that normal wear and tear is what's reflected in the estimated economic life, and then therefore the depreciation that's captured by the published personal property tables. It's capturing that normal wear and tear. But physical depreciation can also be caused to negligent care, where a property is not maintained properly. And so then there's damage, deterioration to the property due to negligent or inadequate maintenance, and then any other kinds of damage where properties are damaged in some way. It could be due to flooding, to fire, breaking, things like that. The key is typical physical depreciation is expected. Property depreciates over time, it loses value, and that's what we think of as physical depreciation. That means, though, you might have to make adjustments for physical depreciation that's above and beyond what is typical. So if there is property that has atypical physical depreciation, you might have to adjust for that separately. Some of the things to remember about physical depreciation is that it's intrinsic to the property itself. So it's some sort of depreciation or deterioration that is to that specific piece of property. Physical depreciation can be curable or incurable. I mentioned this a second ago. So for Colorado ad valorem purposes, typical physical depreciation is already accounted for in the personal property tables. Normally, you're not making an adjustment for physical depreciation beyond what's already being captured in the percent good tables, because that's taking that into account as long as you're using the correct economic life. But you may need to adjust for additional physical depreciation on a case-by-case basis if there is property that is subject to additional physical depreciation. Okay, so when we're dealing with functional obsolescence, this is where the property is somehow functionally obsolete. This could be due to a poor plan for the property, design, style. One of the best examples and easiest to illustrate thinking of functional obsolescence is with high-tech property. Think of a computer. Computers depreciate very quickly. And most of that depreciation is actually functional obsolescence, not physical depreciation. Because of rapid technology changes, a computer becomes obsolete very quickly because it no longer meets current market standards because the technology is changing so quickly. And so when you have those technological changes, that can lead to functional obsolescence, where your subject property now is functionally obsolete. It no longer meets the demands of the market. So it could be also due to mechanical inadequacy or super adequacy. You see this especially more on like the manufacturing side, where you have machinery and equipment that is inadequate. It doesn't perform up to the standard that it should due to some sort of internal defect or obsolescence, or it could also be super adequacy. And so sometimes this one's a little hard to think about, but if you have a piece of machinery that is over-engineered, or it's super adequate relative to the actual need for that type of property, that super adequacy is a type of functional obsolescence. And so the reason why sometimes that's confusing is that you think, well, functional obsolescence means there's something wrong with the property. And that's not always true. In the case of super adequacy, it's not that the machinery is necessarily deficient, it's that it's super adequate, meaning a rational market participant would not pay, and not to get into a value and use value and exchange thing, but just think of it conceptually. A rational market participant would not pay for a super adequate piece of property that is going to be used in the same function that it's currently being used in. So because there's this excess capital that's built into it, because you overbuilt or overinvested, you put in too much capital investment, and so now that property is super adequate, and it actually affects the value of that property. But you can adjust for that functional inadequacy or super adequacy due to the size, style, age. We already talked about technological innovation a little bit with the computers. That's an easy one. Also changes in manufacturing techniques. So property that just isn't constructed the same as it used to be. That is a little bit easier to see on the real property side. On personal property, it can be there as well, but it's a little harder to see sometimes. And then changes in consumer tastes. You'll see that as well. Okay, so those can all be causes of some sort of functional obsolescence. The key to remember with functional obsolescence is that it is intrinsic to the property itself. The property itself is functionally obsolete. And this is going to be important to distinguish this from economic obsolescence. So with functional, it's intrinsic to the property itself. Functional obsolescence can also be curable or incurable. So you'll have to look at that cost to cure and see if it makes sense economically. And then it's not directly related to the age of the property. This is important to think of. Age can play a role, and we were just talking about that. Let's use the computer example again. Let's say you have a laptop that's 4 years old. Part of that functional obsolescence is related to its age, because a lot of technology changes over 4 years, so that property is going to be more functionally obsolete. So you can see there's age plays a little bit of a role, but not directly. What's really changing is market expectations of what that property should do. So you can have functional obsolescence on old property, new property. It's not directly related to the age. So just because a property is older doesn't mean that it has more functional obsolescence. So this becomes important if you're actually adjusting for functional obsolescence. And let's say you have multiple assets that have an impairment and you're adjusting for functional obsolescence, but one property is 2 years old, another one's 5 years old, and maybe there's one 3 years old in the middle. The property that's 5 years old is not necessarily more functionally obsolete than the property that's 2 years old if they're suffering from the same defect. So you can see that it's not directly related to the age of the property. Age plays a role because older property may have more functional obsolescence in the fact that it's more removed from current market standards, but that by itself doesn't mean that age is causing the obsolescence. It's things, other types of influences. And external or economic obsolescence is obsolescence that's caused by something outside of the property owner's control. And it's also not intrinsic to the property. So what can cause it are things outside of the property, like adverse economic conditions. That's going to be the main one. That's why external obsolescence is usually called economic obsolescence, because it's referring to adverse economic conditions, again, outside of the property owner's control. when the housing market is doing poorly and there's not a lot of new construction, you'll see, or you may see, economic obsolescence in industries that produce building materials. So if you're a cement manufacturer and there's no building going on, there might be economic obsolescence in that industry or in other industries that are related to building. So that's the most obvious one, adverse economic conditions. That's also the one that's the hardest to prove, and we'll talk about why in a second, because it's easy to claim that there are adverse economic conditions. It's another thing to prove that there are adverse economic conditions. Another one could be the passage of restrictive legislation. Again, something outside of the property owner's control. Let's say tomorrow, what was it, Amendment 64 that legalized recreational marijuana? Let's say that was repealed tomorrow. And now all of a sudden, all of these recreational marijuana shops couldn't do business anymore. Would that create, that is an example of restrictive legislation that would affect that industry. And a lot of that personal property would be affected. Now, not all of it, and we'll talk about that in a second. It has to be property that is not easily moved into another sector. That one doesn't happen too often, but anytime you have restrictive legislation, that could cause external obsolescence outside of the property owner's control. Another one is loss of material or labor sources. So let's say that you are a manufacturing company and you produce, this actually happened in the building industry. Let's say you're a lumber company and there's a lumber shortage. And this happened, which is where you started to see more metal framing even in residential applications, because for a long time there was a significant lumber shortage. And if you can't get the material that you need to produce the product that your business creates, that's totally outside of your control. And that it could cause economic obsolescence where, again, outside of your control, you can no longer operate your business in the way that you were because now the source of materials for you to produce your product have gone away. You can also see a shortage of labor sources. So if you can't get the labor that's necessary to produce it, and this can happen with skilled labor, unskilled labor. If you can't get enough professionals to work in your industry, if you're doing like semiconductor manufacturing and you need professionals and those people aren't there, you can't fill the jobs, totally outside of your control. There's just a labor shortage that can cause obsolescence as well. And the key that we're going to talk about in a minute is it's easy to claim these things. It's another thing to prove that they're actually happening. And so keep that in mind. Economic obsolescence is seldom curable. And the reason for that, if you think about it, is the reason it's seldom curable is because it's outside of the property owner's control. The oil and gas industry tanks and the commodity price of oil goes down. There's no way to cure that, right? If you're the property owner, there's nothing that you can do to remedy that situation. And so it's very seldom curable, and which makes sense, which means you're going to have to do some sort of adjustment for it if it exists. This is also not related to the age of the property. And again, it's external to the property. So this is where the distinction is between economic obsolescence and functional. Functional is intrinsic to the property. Something about that property no longer meets market standards. It doesn't function like it's supposed to, whatever the situation is. Whereas economic obsolescence has nothing to do with that. Totally outside of the property, and it can also go away. That's the key. Another difference between the two is physical depreciation and functional obsolescence, because they're intrinsic to the property, generally are not going to go away unless they are cured. Economic obsolescence can be there 1 year and then go away the next because it's related to these other adverse economic conditions or things outside of the property that can come and go. So it's more of a moving target. There is an important court case to be aware of. It's Colorado and Utah Coal Company v. Rorex, the Colorado Supreme Court case in 1962. And that case said that if economic obsolescence does in fact exist, it must be acknowledged and deducted. And we'll talk about this when we deal with how to quantify this, but that is going to be the key is if it exists, you have to acknowledge it and deduct it. But the key, the first part of that is you have to prove it exists. Just because a taxpayer claims that there's obsolescence doesn't mean that it actually exists. And so the first hurdle before you even get to the quantification piece is proving that there really is some sort of obsolescence, whether it's physical, functional, or economic. You have to prove that it exists, and then you have to quantify it appropriately. And this is what we just talked about. You have to prove that it exists. And so to document it and then quantify it. And we'll talk about what kind of documentation you would typically look for in just a second. Okay, so how do you document this? That's going to be one of the keys that you're going to have to think of. And it's different depending on the type of depreciation that you're looking at. So when you're dealing with physical depreciation, the way to verify that is going to look differently. So it's going to be mainly done through physical inspection. So if a property owner claims there's additional deterioration to my property, the way to verify that is really to go look at it. And this is where it's a little subjective, but as an appraiser, if you have familiarity with that type of property, you can look at it and say, okay, relative to other property that I'm aware of that are similar in age and all of that type of stuff, this property is clearly has more wear and tear, it's more broken down. You can make those kind of calls. They are judgment calls, but as an appraiser, you can sit on the fact that you have experience, you're familiar with this kind of property, you know what typical depreciation would look like, and you can say, okay, this is above and beyond. So that's where your appraisal judgment is going to have to come in. You can also look at historical information. So that's going to be more relevant to determining general depreciation. So if you know what the original historic costs were when the property was acquired, you can determine some of that depreciation just by looking at historic information. And then, as I mentioned with the physical inspection piece, a big part of that is looking at comparable property. You want to know if a property is subject to additional physical depreciation. You have to look at it, but then you have to think about how does it compare to like property, because you have to have a point of reference. If you just look at a piece of machinery, you might not be able to tell if there's additional physical depreciation beyond what's typical unless you know what typical is. So you have to have that kind of knowledge and experience of, well, what is comparable property like in terms of its condition? That's another thing you can do to adjust for this. I don't know if your CAMA systems, if you can do this or not. So if you take property and you run it through the tables, that's accounting for typical depreciation. Let's say you need to adjust for more. You can do some sort of manual override, but I don't know, you might have a condition feature. We assume most property is average condition. If on your personal property side, if you can adjust the condition, that's a good way to adjust for additional physical depreciation, is to change that condition rating and change it from an average to a poor or something like that. It goes both ways though, and this really isn't a part of the class. This is more on the cost estimation side, but if a property in theory is in better condition than what you would expect for its age, then you'll do an effective life adjustment. And we'll talk about that very briefly, but this actually goes both ways, where you can actually increase the value of the property because of its physical condition as well. But typically, we're talking about decreasing value, right? So that's how you would document it. That's not how you would actually make the adjustment, but basically you're gonna have to look at the property and make that kind of judgment call. And the problem with physical depreciation, because it's so intrinsic to the property, it's not something that you can generally get from like third-party sources, because it's going to depend on that specific piece of property. So with functional obsolescence, it's going to be similar. Historic information, that could be when was it acquired, when was it built, where was it built, what was the original quality when it was purchased. Obviously, within personal property, just like real property, there are different qualities of personal property. I'm sure you all know this. You can spend a lot of money for nicer property. This comes up in restaurants, where there's a big difference in the values of restaurant equipment. And if you go into a custom kitchen in a higher end restaurant, depending on what kind of brand they purchased, that is going to be a much higher quality than some of the comparable property that you might see in just a kind of mom and pop, lower tier type restaurant. And so that comes into effect as well. So you need to understand, well, what was the original quality of the property? Again, look at comparable property. Look at manufacturer's information, which is, especially if you have manufacturing property, the manufacturer almost certainly has it rated to produce so many widgets, whatever it is per hour, something like that. See if it still meets that. And if it doesn't, why not? And then also look at market trends and analysis. And that's important when you're looking at changes in preferences in terms of the market. So you can look at what's going on with computer speeds. Again, because of high-tech property depreciates so quickly, because of inherent functional obsolescence, you can look at, okay, think of it like a laptop. Okay, this laptop that is 4 years old compared to a laptop that's brand new, what's the difference in terms of the capabilities? How have the processor speeds increased over time? How have RAM, other memory requirements increased over time? And so you can look at current market to determine whether or not your subject property meets current market expectations. And so that's how you would document functional obsolescence. Functional obsolescence is easier to adjust for when you have inutility. And we'll talk about inutility in a minute in terms of one of the methods to depreciate property. It's easier to measure when you can easily point to, okay, this property has some sort of physical defect or something that's making it functional obsolete and it no longer meets what it was rated to produce or something like that. That's the easier way to do it. When you have to make functional obsolescence adjustments for market changes in market and things like that, it's a little bit more difficult, but it certainly can be done. And then documenting economic obsolescence. You could look at increased operating expenses. And so this is because you have to be careful. When you're looking at economic obsolescence, what we're really trying to get to is the personal property subject to economic obsolescence. And a lot of the measures or things that you can look at as indicators of obsolescence are also involving larger economic considerations, business considerations that may or may not directly relate to the value of the personal property. So you could see increased operating expenses and have that not indicate obsolescence. So that by itself does not mean that there's obsolescence, but that could be an indicator that they're having increased operating expenses because maybe there's or a material shortage, and so now they're going up because because of those things that are outside of their control. Reduced economic income, that's another one that's a little squishy because economic income can go down without it necessarily reflecting a decreased value in the personal property, but it could be an indicator. And then the key one is going to be some sort of reduction in the market value of the property. We won't get too much into that. That's really a method. But if you look at comparable sales of property in the market, you can determine that, yeah, there is obsolescence. And then any other economic indicators. There are lots of good resources on economic factors. You can do national sources. The Federal Reserve, publishes lots of reports on economic indicators and what's going on nationally. There are regional and local estimators as well. A really good one is the one that's published by the CU Leeds School of Business. Every year they do an economic outlook forum, and they are projecting, but they're using actual data to do their projections on what they're forecasting for economic conditions within the state. That can be very helpful because they break it out by industry. And so if you have a particular taxpayer in a particular industry claiming obsolescence, you can look at that industry and say, well, the economics are actually showing the opposite, that this industry is growing, perhaps, and not shrinking. So there's lots of those kinds of indicators. You can also look at, really anything that could give you an indication of the economic picture for that industry. And some of it's going to depend on, in terms of which direction you go, whether you look at international, national, regional, local. It's somewhat going to depend on the type of personal property that's involved, the type of business. So again, like commodity intensive industries, coal, oil and gas, precious metals, base metals, those are very much influenced by what's going on internationally because it's an international market for a lot of those goods. So you might want to look at an international level or a national level. But when you're dealing with a lot of industries, and this makes sense within the country and within the state, is think of the different markets. What's going on in New England is not necessarily related to what the economy is doing in Colorado. What's going on in California, not the same thing as what's going on in Florida. And so just because there may be economic obsolescence in a particular industry in one part of the country doesn't mean it exists in Colorado. And so you have to regionalize it somewhat. And then even think of locally within the state. There are different markets within the state. And think of like the housing market. The housing market in the Denver metro area is crazy. Is the housing market seeing those same kinds of increases on the eastern plains? The answer is no. On the southwestern part of the state, the answer is no. So even within the state, there are different economic regions. And so you have to think of that when you're thinking about economic obsolescence, which is is the property, the subject property in my county being affected by these external indicators? Okay, so now we're going to talk about the quantification part. So we're going to talk about some different methods for quantifying. So with physical depreciation, the primary way to adjust for depreciation is through published tables or using an age life methodology, which we're going to talk about later, which is a straight line depreciation. But essentially, you can account for most physical depreciation that way. Now, in terms of quantifying it, when you have stuff that's atypical, that's going to be where it's more difficult, and you're going to have to use your appraisal judgment. Because let's say you look at a piece of property and you conclude, yes, this property has physical depreciation that is beyond what is typical for this property given its age. The question is, well, how do you adjust for that? There are some methods to do it, but it's going to be kind of a judgment call in terms of like a percentage adjustment or something like that. Apply an effective age adjustment, and we'll talk about that in a minute, how to do that. And so then that's something that you can actually stand on and say, this is how I came up with my adjustment. For functional obsolescence and economic obsolescence, a lot of the ways to quantify that are actually the same. The key is you have to know what you're trying to solve for because they're caused by different things. But in terms of how to demonstrate them, they're often demonstrated the same way. A good example of that is inutility. You can measure inutility that is accounting for some sort of functional obsolescence, and then you can also use inutility that's accounting for economic obsolescence. So you have to know going in as the appraiser, which one are you trying to solve for? Is what you're trying to solve for a functional obsolescence issue or an economic obsolescence issue? And the reality is there might be a little mixture of both, and you can't separate the two, which is why you might just have to come up with like an aggregate obsolescence factor that's really both. But the point is, a lot of the methodologies for determining that are going to be the same. There are lots of ways to estimate obsolescence, but there are only 3 that are generally applicable for ad valorem property tax purposes. And these are in the ARL, and that is capitalizing the loss in income, which is a rent loss methodology, direct sales comparison, or inutility. In a little bit, we'll talk about other methods. If you open up the ASA text and you go to how to calculate it, they have a bunch of different ways to do it, but most of them are they're not appropriate for the kind of valuation that we're doing for ad valorem purposes. Well, let's talk about these 3, since these 3 are generally applicable. The first one, and the one that's the most common that you'll see in appeals, is direct sales comparison. And this is where you are going to take your subject property that you believe is subject to some sort of obsolescence and compare it to the sales of comparable obsolete property. Okay? And then the difference between your calculated RCNLD and the sales prices, assuming that they truly are comparable, the difference between those sales prices should be all forms of obsolescence. Okay? And so the reason why we're using RCNLD as the starting point is we're already assuming that there's typical physical. So we're still going to depreciate it through the tables. But what we want to make sure that we do is that at the end of that, we have a good RCNLD basis, and then we want to compare that to the sale of comparable obsolete property. And you can also do this for particular, business activity codes. This is one of the drawbacks of this method, is it's very difficult to get direct sales that can be used. It's not like real property where you can find comps with a little bit more ease and do paired sales analysis to figure out your adjustments. It's a little bit more difficult doing that with personal property. But the key is, now in terms of what this can measure, is something like a supply and demand imbalance. So if you have economic obsolescence that really does exist and that's causing adverse economic conditions, businesses are closing, going out of business, property is being liquidated, sold on the second tier market, you could cause a supply and demand imbalance where now there's way more supply than there is demand for that type of property. And when you have those sales prices of that obsolete property, that sales price can reflect economic obsolescence. Now, here's the problem with this, is that stores are closing, that personal property ends up on the second tier market, there's a supply demand imbalance, therefore our property is worth less. The question is, you have to prove that that's what's really going on. There is always, in any given market, you're going to have different tiers in that market. And you have to look at where that property is actually being bought and sold. Just because there's a used secondary equipment market doesn't mean that the property is therefore worth what that price is that you're seeing in terms of your sales prices. But again, that secondary market, those used prices should still be typical used sales. What you have to be careful of is usually that they're not. Auction sales are not automatically disqualifiable. Just because the property sells at auction doesn't mean that the auction price is bad. And there's lots of appraisal theory behind that, which is you have willing buyer, willing seller, you have a sales price. Auction prices can be indicators of market value. The question, though, is does the auction price represent market value? And the answer may be no. And that's where you have to look at other considerations. What were the requisites to a fair sale? Is it really a liquidation value, a salvage value? Okay, keep going. If you're doing direct sales, you want actual sales. And you need to be able to confirm the terms of those sales. So if a petitioner shows up with hundreds of pages of supposed sales, they should be able to tell you who was the buyer, who was the seller, what were the terms of the sale, how much did it sell for, what exactly sold, what was the condition of the property. That is all requisite to having an actual sale. And so if you don't have that information, you can't do sales verification or your sales confirmation, right? And even on whether it's real property or personal property, you have to confirm your sales. And not appropriate just to bulk everything together and say, oh, these are all sales. You have to show that they really are sales. That these really are arm's length transactions. What was the intended use? So why was the buyer purchasing the property? And this can tell you the trade level. If they're buying it because they're just going to resell it, that's not an end user for that property. And so that sales price does not reflect the market value for that property because they're not the end user. We value all personal property at the end user trade level. Okay, so there's that. As I said, bankruptcy, liquidation, distress sales are generally not appropriate because they are not market transactions. They are liquidation, distress sales. Now, one thing to be cautious of when you're doing direct sales, you also need to make sure that the property really is comparable. A computer is not necessarily a computer. So if you just see a line item that says computer and another line item that says computer, well, what does that mean? They need to be somewhat comparable. Now, with personal property, it's a lot more difficult to come up with true paired sales. This method works. It's a very good method. The problem is that it's often done poorly. And so that's going to be the key if you ever see these come across in appeals, is looking at it and saying, did they do it correctly? The method is sound, the methodology is sound, but it has to be applied correctly. All right, that's a lot about direct sales. Let's move on to capitalization of loss, also known as the rent loss methodology. This is also a very good method to use. The problem is, just like with the income approach generally for personal property, you have to have an income stream to that piece of personal property, and usually you don't have that. Most personal property, think of a retail business. Most of their personal property, there's income to the business, but there's not income to any individual asset within that business. So generally not applicable, but if you have leased personal property where you do have an income stream, or very specialized type equipment, or very single purpose type equipment, and what you do is just you estimate your typical net income. The difference between what the typical net income would be and the actual income, you just capitalize the difference between those, and that difference is attributable to obsolescence. When you're developing your cap rate, you just have to be careful to build up your rate and make sure that you load it with an effective tax rate. Trying to develop cap rates for personal property is very difficult. And again, what you do though, if you can capitalize that income loss, then you would just deduct that from your capitalized value and come up with your obsolescence. I already talked about that. It's difficult to use, but if you can use it, it's great. Here are some of the other methods, and we're still going to talk about Inutility in more depth, but here's just some of the other ones. These are all from the ASA. You could look at equity to book ratio analysis. This is not appropriate for ad valorem, but if you were doing a business valuation, equity to book ratio analysis is a good way to do that. And you can look at the difference between the equity versus the book value and look at the ratio between the two. And that can give you an indication that there's loss in value. You can also look at gross margin analysis, where you look at, this is especially helpful when you have manufacturing, and you can look at gross margins that were paid for products in the past versus current market, and the difference can be attributable to some sort of obsolescence. Neither of those, I've seen them done in appraisals, but neither of them is very relevant to ad valorem because we're not doing business valuation. Both of those are highly influenced, as you can see, by the economics of the business. The other one, which is not really a different method, but I want to bring it up, is what the ASA calls a remaining or aggregate obsolescence factor. And what this does is to come up with these aggregate factors, which is where you group assets into similar categories and you find sales of property within those categories, and you use that to extrapolate an obsolescence factor that you can apply to everything. But you just have to be careful. I've seen this done very well, where the assets are grouped appropriately and it really is done well. I've also seen it done very poorly. Okay, here's Inutility. Inutility is a very useful way to estimate both functional and economic obsolescence, as it measures the loss in value to the personal property due to underutilization. And so if you have that unused or underutilized capacity, that can indicate that there's obsolescence. Here's the basic formula. It's 1 minus capacity B, which is your actual capacity, over whatever your capacity would be. And then you have an exponent, which is called a scale factor. We'll talk about that in a second, multiplied by 100 to turn it into a percentage. That's the basic formula. There's an example below there. 1 minus, if you had actual production of 12,589, expected production would be something like 40,000. And then you have that scale factor, and you can turn that into an inutility factor for an adjustment. But what it's comparing is what a property should produce versus what it's actually producing. And this can be used to actually measure all three forms of depreciation or obsolescence, but it's typical for economic and functional. So if you look at inutility, and if the cause of that inutility is economic, that will give you an economic obsolescence adjustment. Now, so here's the cautions when doing that, because inutility is actually a very good way to do this. The scale factor, that exponent, is difficult to determine. And if you've ever tried to do this, you know there is a formula to do it. There's a methodology to do it. We're not going to go over that right now, but it is there. Okay. The other issue is limited applicability of using inutility. Inutility only works if you have some sort of capacity that can be measured and that therefore is subject to inutility. So for most personal property that you're appraising in the counties for tax purposes, this inutility factor is not at all helpful because you can't measure some sort of expected output or anything like that. It's mostly used in manufacturing because with manufacturing, you can estimate output and you can do those things. But with your general personal property, retail, restaurants, hospitals, whatever kind of personal property you're talking about, inutility is just not relevant. So it's very, very good for certain applications, but it's also it's just not applicable in others. The other thing you have to be careful of if you are using this is that it's very easy to exaggerate the amount of obsolescence. Because if your capacity A, which is what you should be producing, is inflated, that can cause problems. So let's say you have a machine that's rated to produce 10,000 whatever things per day. That's nice, but what about downtime? What about repairs? Things like that, that are going to actually decrease what you should produce. And it may be too that you've never produced at that. That's maybe perfect world. That's what the manufacturer says you might be able to do, but you've never been able to pull it off. If you're using a kind of perfect world scenario, you might be overstating how much obsolescence there really is. You need to compare. What we generally recommend is looking at historic information and comparing historic information with current information. Because if you've historically produced at a specific kind of rate, and then now there's obsolescence, and now you're producing at, say, 40% of that, Well, there you go. You can easily point to inutility that's causing obsolescence. But if you're trying to estimate, perfect world scenario versus now real world with obsolescence, you can overstate that. So just a caution, something you need to be aware of. Okay, that's inutility. Something else, be careful not to double deduct. I mentioned this earlier. It's very easy to double up on depreciation. So if you say you run them through a property through the tables, you come up with a physical depreciation, an RCNLD. Okay, that's fine. But then you start looking at let's say you're doing direct sales to come up with an obsolescence factor. That's fine. But you have to remember those obsolete sales reflect all depreciation, not just one type. And so if you come up with like an obsolescence factor, like an aggregate factor, and then you apply that aggregate factor to already depreciated assets, you're probably going to overstate the depreciation because now you're doubling up on physical. So just something to be aware of in terms of how it's applied. You don't want to double up. And then another thing that we can talk about very quickly, it's not really, I don't have slides for it or anything, but just remember, when we're talking about depreciation, we are not talking about depreciation for IRS purposes. I know you all know that, but just remember, they're not the same thing. Accounting depreciation for IRS and for income tax purposes are not the same thing. Okay, a few more things we have to talk about. And this has to do with economic lives. And I mentioned this right at the beginning of our webinar session. The reason this is important is because the economic life of a property is related to the depreciation of that property. And we divide economic lives into three general categories: long-lived assets, average-lived assets, and short-lived assets. Okay? And as I mentioned earlier, typically long-lived assets depreciate more slowly, short-lived more quickly. These are the characteristics of like a long-lived property. Generally, these are going to have a relatively large investment in relation to the value of the unit that's produced. So this is, think capital intensive, expensive equipment, large upfront investment. This is going to be most common in heavy manufacturing. Metal applications, sugar, oil, paper products, cement manufacturing, milling work, all of that type of stuff, that heavy manufacturing equipment. That equipment is designed to last a long time. You'll see this in mining. Mining equipment is designed to last for a long time. These are long-lived assets. These are also characterized by infrequent changes in how the property is produced. It has a long life, which means it's not subject to a lot of technological changes. So you're not going to see a lot of like functional obsolescence in this equipment because it's designed to last a long time. The processes are pretty well established. This equipment is also going to be very serviceable usually. Not only is it designed to last a long time and have a long economic life, it's designed to be repaired usually. And so you might have to change the effective age. And we'll talk about how to do that in a little bit. So think of like your item, your 20-year economic life type stuff. Our tables stop at 20, but some personal property really has almost a life of like 25, 30 years. Again, characterized by durability, difficulty to move, relocate because it's generally heavy manufacturing type equipment. Note that this is not the same thing as long-lived in accounting. You might see that phrase in accounting stuff. They don't mean the same thing. That has to do with how long the asset has on your books and stuff. So not the same thing. Here are some examples: leasehold improvements. Generally, it depends on the actual leasehold improvement. Renewable energy property, solar panels, wind turbines, that type of equipment designed to last a long time. Heavy machinery, gas plant equipment, underground storage tanks. You get the picture. It's that kind of equipment. Here's some other examples. Again, heavy manufacturing equipment. Here's a bucket crane. This is at a surface coal mine, not in Colorado, but we do have these in Colorado. Up in Moffett County, there's a surface mine. And this is how they use it. They use these big drag lines with these buckets, and they use them to get the coal. Very clearly long-lived assets meant to last a long time. This is a gas turbine. This is a marine turbine, but fairly old, but this is a museum. But gas turbines are designed to last a fairly long time. This is a bottling plant. A lot of that equipment we would classify it as a long-lived asset. I mentioned wind turbines. other renewable energy property. Here's a gas plant. A lot of that equipment will be considered long lived. Not all of it, of course. Some of the equipment will have much shorter economic lives, but a lot of it will have the long lived categories. Okay, then we have average lived. This is going to be the bulk of your personal property that you're valuing, which is common across different businesses, industry types. Again, just kind of an average lived type property. This property is susceptible to obsolescence in both functional and economic terms. And again, generally fairly mobile. And again, this is going to be your broadest category. Everything from furnishings, fixtures, equipment, retail property, light machinery, agricultural personal property. A lot of that's exempt, but the stuff that's used in like an agribusiness, most of your personal property is going to fall in this category. And then we have short-lived items. These are properties, a personal property that is subject to a very high rate of either wear and tear, so very fast physical depreciation, or very rapid obsolescence due to technical issues. So computers are a good example where you have a relatively short economic life because they become technologically obsolete very quickly. Some other examples are things like that are not considered consumable, but like molds, dyes, lathes, things that are used in manufacturing, but that have very short lives. A lot of property used that is not itself high tech, but it's used in the production of high tech equipment, semiconductor manufacturing, other types of high tech manufacturing. That property generally has very short lives for various reasons. And also computer integrated personal property, because it's one unit, even though there's a mechanical component, that mechanical component doesn't function without the computer piece. And so as the computer piece becomes obsolete, the whole thing becomes obsolete. And so these are characterized by fairly short economic lives, which means they depreciate very quickly. And that's kind of the takeaway in terms of how that affects depreciation. Okay, effective age. Effective age is the age of the property as indicated by its condition and utility. That's the textbook definition. But basically, the effective age is how old is the property in relation to comparable properties. And so the effective age can exceed the actual age. So let's say you have a piece of ag equipment that's not exempt, but agricultural type equipment, it's not maintained, they leave it out, and it's subject to snow and wind and rain, and it's rusted, and it just doesn't function that well. Let's say it's only 5 years old, but the effective age might be 10 years, 15 years, just because it hasn't been maintained, poorly maintained, things like that. Effective age can also be affected by obsolescence and also high usage, where you have that additional wear and tear. You might have property that is really only a few years old, but it's like it's really 8 years old, something like that. And then effective age can also be less than the actual age. This is where you have personal property that's either very well maintained, and so it's in better condition than what you would expect for comparable property at that age range, or it's been refurbished. And that is typically how you would account for refurbishments in the county, is that you will do an effective age adjustment. Again, determined from the deck schedule, physical inspections, things like that. A different concept that's related is remaining economic life. And so remember, this is one of the differences between the physical life. Physical life is how long is the property going to physically be there before it actually starts like falling apart and not functioning any longer. Economic life is how long does the property continue to be in use and have some sort of positive net economic benefit to the owner of the property. That's some sort of net return. And so remaining economic life is the period from your appraisal date to that end of the economic life. And the difference between those is how much economic life is remaining. A fairly simple concept, but important to remember. We're going to talk about the Iowa Curve study. But the reason it's important to know, back to what I said earlier, is even though you and the counties are not developing your own depreciation tables, we do that at the division. I'm sure a lot of you can relate to this. How many times have you had taxpayers challenge that depreciation and say, well, where did this come from? Why is this a depreciation? Especially when it's different than what they're using for like IRS. And this is the answer to that question. This is what it is, and then why we use the Iowa Curve study. So the history of the Iowa Curve study is, it originally started from the engineering station of Iowa State College, which is now Iowa State University. Back in 1916, they started conducting studies for the retirement of specific assets, essentially a mortality study. And this was expanded in the 1920s and 1930s. And then finally in 1931, the results were published in something called Bulletin 103. And you can go find that online if you're ever bored. And they established 13 survivor curves. And what they were doing is they were tracking particular assets over time to see how those assets were retired or taken out of service. And essentially you can come up with a survivor curve or kind of like a mortality curve, which tells you how often these assets are going to be taken out of service and when within their economic life or expected normal useful life that retirement is occurring. They came up with 13 survivor curves, and that's been expanded, and we'll talk about that now. Then you have Bulletin 125, which came out in 1935, which is the statistical analysis of industrial property retirements. That Bulletin 125 expanded it to 18 survivor curves, and the breakout was 6 left modal curves, or L curves, and we'll talk about what all this means, 5 right modal curves, or R curves, and then 7 symmetrical modal curves, or S curves. And that was revised in 1967 to add 4 what are called origin modal curves, or O curves. Now, what does all of that mean? Let's talk about it. Okay, the L curves, or left modal curves, this represents property where the greatest number of retirements occur before the average life of the property. Okay, so if you have an average life for this property, most of them are going to be retired before that happens. And here's the little graph. This is from the California State Board of Equalization. And you can see there's 5 different L curves, and they all represent different retirement patterns. And what it means there, if you look at on that graph, okay, I do. See this 100 right here? This is your average life, okay? If you follow this line up, if I can draw kind of straight, okay, see how this the peak of this curve is to the left of this average life, okay? What that's saying is most of your asset retirements are occurring on this side of the average life. And that's all it's saying, okay? And that'll be important here when we talk about the R3 curve. So that's all it's saying. And we're not going to get into the statistics behind all of this. All of this is very stats intensive, but that's well beyond the scope of this course. It's complicated. If you ever want to talk about it, you can call me and I can talk about it, but not today. Okay, then we have the S curves. These are symmetrical curves. And what these curves are is that they're not skewed either left or right. Okay, so which means the greatest retirement frequency occurs at the average life. So go here. Here's 100. Here's your average life. You can see they're not skewed either left or right from your average life. Okay. The S curves are there's not a right or wrong. These curves describe different types of assets. Then we have the R curves, and this is the curve. This is where what we use becomes involved. The R curves are called right modal curves, and this is where you have the majority of asset retirements that occur after the average life. So the expectation is essentially that most assets will hit their average life and actually exceed their average life. Okay, and this is the famous R3 curve that we talk about all the time, and no one knows what we're talking about. Here's your average life. If you draw that up here, notice how all of these are to the right of the average life. Okay, so what that's saying is you have some asset retirements down here, you have some down here, but most assets are going to hit their average life and actually exceed their average life and are going to retire on this side of the graph. Okay, and we'll talk about why that's what we use. But that's all it's saying is that the majority of assets are going to hit their average life and actually exceed their average life. Okay. Okay, and we'll spend more time on the R curves because that's what we use. But let's talk about O curves. O curves, I don't have a graph for this one, but this is where you have really high failure rate in the first year of the life of the property. And the question is, okay, well, why? And the reason these were adjusted for is when they were doing their studies at Iowa State University, they had certain assets that didn't fit the curves. They had to come up with new curves to fit these. And this is where, again, you have really high failure rates. So what it's saying is that there's a very high chance that the property is going to fail in the first year. But if it makes it past that first year, it's generally going to work for a fair amount of time. And so sometimes it's called the infant mortality curve, because it's almost like an infant mortality type curve where, not to get too morbid, but if you have really high infant mortality rates and lots of children die, basically it's, if you get out of childhood, your chances of living are pretty good, but you have really high infant mortality, so your chances of dying in childhood are very high. This is kind of the same thing. That initial period, you have very high mortality for the equipment, but if you get out of that period, the equipment's going to function and it's going to work. Why do we use the R3 curve, and how do we come up with our depreciation tables? Now, this history is important because one of the things that happens is occasionally our tables are challenged in appeals, which is not really the right venue. If you say our tables are wrong, you really should just tell us and actually participate in our, every year we have open meetings where we invite everybody. You can give any feedback about the tables. You can say they're wrong. You can give us studies. You can do all that kind of stuff. No one ever does anything, right? What they instead do is they wait, they complain to you at the county level, protest, and then their argument ends up being, well, the state's tables are wrong. And the question is, well, why didn't you tell the state about that? And the answer is usually crickets. It's like, well, we don't know. But the reason this is important is this shows that these tables have been around for a long time. They are very firmly established. There is lots of precedence for the reliability and use of our tables. And here's some of the history. Before 1977, and this goes back way before that, but before 1997, that's when a change occurred. The DPT published one depreciation table for all personal property. And with that depreciation table, economic lives ranged from 10 to 30 years. And then there was a floor value of between 2 to 4%. So it never went to zero. And the history here is that it was in 1963 that the Colorado Tax Commission adopted the R3 curve. So we have been using the R3 curve as the basis for our depreciation since 1963. That's a long time. There's a lot of precedence behind using this curve. It's been established, it's been defended for a very long time. And the reason why the R3 curve was chosen back in 1963 was that the belief of the Colorado Tax Commission was that the R3 curve best duplicated the depreciation trends that were being seen in the Colorado market. So I think what they did, if I remember correctly, is they actually asked the local county assessors to give them data and say, look, you have assets that are being depreciated. When are they actually being taken off the deck schedules? When are they being sold, disposed of? And what's their retirement? And the conclusion was that most assets fit the R3 curve. Most assets hit their average life and are actually in use beyond their average life. And typically, even, assets are used till the end of their expected life. So most property that's acquired and used in a business is going to be used until its useful life is exhausted. And then it'll be disposed of. And that fits an R3 curve kind of methodology. In 1977, this is where the change occurred. The DPT started publishing 3 different depreciation tables, one for commercial industrial, which used the R3 curve, 10 to 30 year economic lives, 18 to 19% floor. For some mobile equipment, they use straight line depreciation with a floor of 30%. So yeah, it was straight line, but you never got below 30%. And then for some electronic, scientific, and related equipment, they use straight line depreciation. Okay, with a floor of 30%. Now this has evolved over time. In 1982 is when the 15% floor was established for all personal property. This was to standardize it, so you didn't have these different floors represented. You just had one floor at 15%. The reason 15% was chosen is they looked at the median residual values. They basically took those curves out further, and they looked at where's the median in terms of when they're hitting the end of their normal useful life, and 15% was the median. So Some would be a little bit higher, some would be a little bit lower, but 15% was the median. So for consistency, that was applied. This is also consistent with value in use. There's a reason why we don't depreciate property to zero. All personal property is taxable and has value as long as it's in use. And when we say in use, that doesn't mean it has no value if you put it in storage or something. It still has value. What we mean is until it's scrapped, disposed of, whatever, that property has value. And it has value because we value all personal property in use to the current owner. It's still market value, but it's not a market value in exchange. It's a market value in use. In 1987, the DPT reaffirmed the R3 curve. Basically, it looked at it and it said, yes, we still think the R3 curve is the right curve to use, and we're going to keep doing that. And it was used to develop a general percent good table. Again, it was seen as the most representative of property retirement patterns in Colorado. And the R3 curve is also used by some other states, including California and Florida. There are other states that use it as well, but those are the two big ones. And Marshall and Swift uses the R3 curve. Now remember, Marshall and Swift is by far the most prominent nationally recognized cost estimation service in the country. I think there's a statistic, I don't remember the exact number, but something like 90-something% of all assessors' offices or their equivalent across the country use Marshall and Swift for something. Marshall and Swift is, of course, a reputable company, and they use the R3 curve as well. So it's not just Colorado out there by itself using this. Lots of people use it. And it's used outside of this, too. Lots of businesses use the curves. A lot of utility companies, especially, when they're estimating how long their assets are going to are expected to last, they use a Iowa curve study depreciation schedule. So it's widely used out there in the world of appraisal. In the mid-2000s, the general percent good table was modified to include a market-based rate. And all that means is, I think we have a picture here. Let me see. Okay. If you graph the R3 curves from our tables, this is what they look like. And don't be confused. They don't look like the curves that I showed you earlier. That's not because they're wrong. It's when you turn the curves into depreciation, they look more like this instead of a curve. But it's not straight line. And if you actually follow those, you'll notice it's not a straight line depreciation. But what that rate does, this market-based rate, is it affects how steep those curves are. The higher the rate, the slower the depreciation, the lower the rate, the faster the depreciation. Within the Iowa curves, there's an assumed rate of return. And it makes sense to change that based on current market conditions. And so that's what we do now. And every year when we publish the percent good table, you'll notice in the ARL at the bottom, there's a little number that says this is the rate that was applied. That's that market rate. So we do adjust these depreciation tables to the current market, and that's why they change. They're not static. So the depreciation will change slightly from year to year. So before we move off of the R3 curve, the point is the R3 curve and the Iowa curve studies more broadly are good estimators of physical depreciation. But what they don't do is they don't account for that additional depreciation that's atypical. That they don't account for. They can't account for it. You just can't do that in these kinds of tables. So if there is a claim by a taxpayer that there's additional depreciation, that's where you have to actually look at it and see if it warrants an adjustment beyond what's captured at the table. Okay, that's the R3 curve. Now let's look at some differences in how this applies. I mentioned we're going to talk about the age-life methodology, and we are. So what is age-life? Age-life methodology compares the age of a property to its expected life. Makes sense. It's in the name. That's why they call it age-life. But it's a type of straight-line depreciation. And so you look at how old is the actual property, how long should the property last, essentially what is its remaining economic or useful life, and the difference between those is straight-line depreciation. That's actually one of the criticisms of this, is that it is straight line. The ASA notes in their text, and there's a little quote there, I'll read it. Although this is straight line depreciation, it should not be confused with accounting depreciation because the appraiser uses valuation rather than accounting concepts of age and life. What that's saying is, yes, it is straight line, but it's not the same as straight line depreciation you'll see in accounting because the original starting point should be an appraised value, right? You're still coming up with valuation versus just depreciation for IRS or accounting purposes. But this is one of the criticisms of this, is that it is straight line depreciation, which means it's not a market-derived depreciation. You're just looking between point A, point B, and you're drawing a straight line, and that's your depreciation. And it's typically only used to estimate physical depreciation. If there's additional functional or economic obsolescence, that still has to be accounted for outside of that, just like everything else. Okay, here's an example. The formula for this is your effective age divided by your physical life, and that gives you a percentage of physical depreciation. So let's say you have a piece of property that has a 4-year effective age, 4 years old essentially, and has a physical life of 10 years. You just do 4 divided by 10, just 0.4, or 40% depreciated, or 60% good, which is the flip side. But you can see it's just a straight line depreciation. It's looking at your effective age compared to your physical life, and there you go. And depreciated over that, so 40% depreciated. Now, as you can imagine, that's not going to look the same as what we do with the Iowa curves. You can also establish an effective age for a group of assets. This is in the ASA text again. I should have put an example in there, but I didn't. But we can use this as an example, where it's not always practical when you're dealing with a lot of assets to come up with age life for every single asset. So what they'll instead do is they'll aggregate it. But this is where you can run into some problems, depending on how the aggregation is done. Okay, so but what you can do is use an age life and come up with an overall effective age. But you have to be very careful because this can be easily skewed. You can, and we'll show the comparison here in a second. So let's look at those 4 assets we talked about: tables, chairs, stove, refrigerator. Okay, these are just made up acquisition dates, made up original installed cost. It doesn't really matter. For our tables, they all happen to be in industry category 6 because it's restaurant type property. These would be our cost factors. We're not going to talk about cost estimation, but you get to your RCN, okay, which is your replacement or reproduction cost new. This is what's going to be different from our tables. You calculate the chronological age, how old the property is, but then you calculate a weighted investment, okay? So basically you're weighting this. And so what you do is you take your RCN times your chronological age. Okay, you take your RCN times your chronological age, and that gives you a weighted investment. Okay, then you add up all of your RCNs down here, you add up all of your weighted investment numbers, and you divide the two by each other. And what that will come up with is an overall effective age. So what it's saying is, for this entire group of assets, even though they have different chronological ages, the effective age for the aggregate is 6.8 years. Okay, so instead of determining depreciation for each asset, they're going to determine it for the entire grouping. So if you have an effective age of 6.8, and you can round it, but we'll keep it at tenths here for a little bit. That's the same thing as saying that it's 68% depreciated if these all have a 10-year economic life, right? So 6.8 divided by 10, 68%. And then the flip side of that, if you turn that into a percent good, you would have a total RCNLD of $8,442. So notice, though, that what's happening is basically you're saying this group of assets is 6.8 years old, even though this asset here is 5 years old, this one's 4 years old, this one's 8 years old, and this one's 9 years old. You're saying that the effective age is 6.8 for everything. And it's important to look at this, because let's look at how this compares to how you would value this using the tables. Okay, here's that same group of assets, same dates, same cost factors, same RCN. Here's our economic life. Here's our actual age of the property. None of that's different. But now let's use our published curves for each asset. Now this one's 59% good, 67% good. You can all see that. Okay, so then you come up with an RCNLD for each line item. This is how your CAMA system works. You do this for each line item, come up with individual RCNLDs, and then you add those together. Now notice what this number is, 11,943. Let's compare that to what we just came up with. The RCNLD using the age life methodology was $8,442. The RCNLD using the tables was $11,943. That's a 41% difference. And so you can see that you can use an age life methodology to estimate depreciation and come up with something that's less than the tables. And it's easy for that to be like, okay, well, we're still kind of doing the same thing, but we're not. So if you see an age life methodology used, know that it may be overstating the depreciation relative to what the depreciation would have been using our tables. But I want to show you a couple more examples. We'll see how this changes. Now we have that same grouping of assets. I changed the dates on you though, and I changed the ages. Remember before these were older, 8 years old, 9 years old, very close to the end of their life. Now they're closer to, now it's 4, 2, 1, 3, so kind of newer property. Using that same age life methodology with a weighted investment, I don't have the numbers here, but if you were to do the math, you get an effective age of 2.6, 26% depreciation on a 10-year economic life, RCNLD of 18,507. Let's look at that same group of assets taken through the tables. Same thing, individual percent goods, 19,531 for our total RCNLD. Now that's only a 6% difference. So what's going on? The grouping of assets that are included in the age life calculation will skew the results. Newer assets, because you have less weighted investment over time, are closer to the values that you would get using the personal property table. But the difference between the two is magnified over time. So with older assets, you're going to see greater depreciation on the age life methodology versus the RCNL versus our tables. Part of that is because they're doing different things. Age life is taking straight lines between 2 points. As you, I'm sure, are aware, if you look at our personal property tables, because it's an R3 curve, think of an item that has a 10-year economic life. That item actually hits its 15% floor in it used to be year 11, now it's year 12. So that's different than a straight line. Right now, you're not doing 10 years, you're really doing 12 years. The other difference is how you build in the residual. Are you depreciating it to 0, or are you depreciating it to 15%? And so all of that is to say, you need to be careful of what you see. Here's some of the takeaways. The age life using an effective age and weighted investment methodology is generally going to be lower than the Iowa curve basis. So just because there's a difference, just because you can use an alternative methodology doesn't mean that the alternative methodology is superior. That just because you're using a different methodology doesn't mean that the methodology used by the assessor is wrong. And the effect of the difference between these two is magnified in older property. It also depends on the mix of the property. And we could have done example after example to see how it all works. But if you have a lot of older assets and you throw in a few newer assets, it's actually going to bring that average down, and it's going to put too much weight on those newer assets. The weighted investment technique favors also higher priced items, because remember, you're weighting the investment. So if you have an item with a much higher original installed cost and therefore a higher RCN, that asset is going to have more weight in your weighted average, which means that it's going to skew it. So if you have certain high priced assets, they can throw off your effective age because it's weighted to their favor. One other thing I wanted to mention is salvage values. Our floor values for all of our tables in terms of our depreciation are 15%. What happens if you have depreciation beyond that? Can you go below the 15%? We get that question a lot. And the answer is yes. And one of the sources that we point to is if you do have atypical depreciation, you can go below the 15% floor value. But what we recommend is not going below salvage value. And that's just a recommendation. And in terms of a source, these salvage values here are from Marshall and Swift. And this is a good source that you could point to, independent third-party source that you could point to for salvage values. Hopefully this was helpful and not super boring listening to me talk forever. But hopefully, at least there were some takeaways you can take from that. Have a good day, everyone, and I'm going to end the call right now. Thanks.
Thank you for watching our presentation. We hope this format will benefit you in your work for ad valorem taxation. If you would like to provide any feedback or have any questions about the course, please contact the Colorado Division of Property Taxation.